Disney shares falling sharply after earnings down almost 9%. Same story that's troubled the company for the past year. Blowout Park's performance mired by persistent streaming losses and weak subscriber numbers. And it's not just Disney. Streaming subscriber growth is stalling across the board, as we heard from Paramount and Warner Brothers this quarter. It's why one of my next guests says the era of streaming wars is over, and the chase for subscribers is not the catalyst for the sector anymore. For more, I'm joined by the Ankler editor Sean McNulty, along with our own CNBC.com media reporter Alex Sherman. Welcome to you both. Alex, I'll just start with you. If the streaming wars are over, who won? Netflix?
I guess Netflix, yeah. I mean, Netflix sort of won before the streaming wars even started. I would say Disney is second. Disney put together a very powerful Disney Plus service that has 157 million subscribers. And then you can kind of, list the winners/losers from there. Warner Brothers Discovery has their Max service has almost 100 million subscribers. So they would be in the middle. And then, Peacock and Paramount Plus toward the end. Amazon and Apple are almost in another category because, A, we don't actually really know how many subscribers, so it's hard to just throw them in there. But B, they're not really in this for the same reasons, right? They have other enormous businesses. They're kind of participating almost as a hobby. So that's sort of how I'd break it down.
And Sean, it was interesting to look at Disney's results and see, okay, so they were expected to add about 400,000 U.S. subscribers. Instead, they had a loss of 300,000. They did do the price hike. They're going to try to push more through to push people to the ad tier, I guess. This is all part of their strategy. But how big do they need to get, including buying Hulu, if that's the direction this is going, to have the scale necessary to say, we are a winner up there with Netflix, and it's going to be worth the investment and generate, decent shareholder returns?
Yeah, and as Alex said, that's U.S. growth. So international is what you want to look at for your other growth at this point for subscribers. Revenue will go up when you raise prices. Your revenue will go up in the U.S., but that's the interesting thing that Iger said was that they're kind of reevaluating their international plan, where essentially saying we've spent too much in markets where we can't make that money back, namely, Disney Plus Hotstar in India, where their Q1 revenue for the quarter was $93 million total. I mean, it was 59 cents for ARPU. I mean, and if you're spending original programming and marketing, so Iger's, he hasn't announced what he's going to do. But pulling that spending back is job one. But the real question is then going to be, okay, well, you have to be global. So what is your footprint going to be? Where Warner Brothers and Paramount have taken this tactic of we're going to make essentially wholesaler deals in these markets where we can't make the money back. So we'll see if Disney does that, or does that Netflix and Apple and Amazon straight D2C global perspective. We don't know yet.
I mean, let me just throw this out there, Alex. So what if Bob Iger were to say, you know what? Streaming takes a lot of money. That's not really worth it to try to be number one. Netflix has a great product. Why don't we just license to them? And we're going to make a boatload of money, and we're not going to worry about all the losses. Would that ever be on the table, or is that a pipe dream?
Well, it would have to be a mix of the two. I mean, I think the ship has left the dock, if that's the right metaphor. Again, there's 160 million Disney Plus subscribers. Hulu exists. ESPN Plus exists. There needs to be a transition from traditional cable to something. And streaming is the something.
But could YouTube TV be that something, right? Especially as we see the cable operators. You almost wonder if they're going to move to this model where they're like, we're not going to offer you a cable product. We'll just offer you YouTube TV, right? And YouTube or whatever becomes the new bundle. They can deal with all the behind-the-scenes drama and offer all the options.
Sure, but what I would imagine will probably happen is that the new version of YouTube TV is a bundle of streaming services. So
yeah, absolutely.
The streaming service would still exist, but it might be packaged differently with other streaming services, and then maybe that's sort of the next leg of growth for streaming. But even still, you look at Disney's share price today, they're down 9%. The story that I wrote on CNBC.com is media may need something else. I'm not sure that this sort of streaming
video games.
Video games.
But I don't understand. How does Disney, and we know, as you mentioned, we know Comcast looked at combining NBC Universal with Electronic Arts. I don't understand what the offering is from combining those two together.
It's a new growth narrative. I mean, streaming was a growth narrative. It's like, look at all these subscribers we're going to get, and hopefully we'll get a multiple bump. And for a little while it happened, at least with Disney. At least if you're going to expand out to video games, you have a new reason to get investors excited, because what's happening right now is investors are looking at these stocks and they're saying, why am I excited?
They're
why am
money
I
holes. They're
investing
money
here?
pits, yeah.
Right. So the only reason that media companies are giving to investors right now is, well, we'll make streaming profitable. But that is not a growth strategy. That's a raising prices and cutting cost strategy.
Right, right. And Sean, I guess the only thing I'd say to that is, are the video game stocks all that attractive? I mean, they're very cyclical. They're very hit-driven. Video game eyeballs are great, but is this really a good business to kind of double down and get into?
Yeah, if you think TV and movies are expensive, try making a video game. I mean, you know, you can make a lot more money. Like with Warner Brothers talking about the Hogwarts game making, you know, $1 billion, a big quarter for them. But, you know, if you miss, that's a big miss. And, you know, getting into that game, it's a very capital intensive game. Netflix has been spending in this finally because they have profits to invest in this. They don't disclose how much they're spending, but they're playing in this game. But even they haven't set a strategy long term as to here's our plan here. All the games they have aren't even in the Netflix app. You have to be a Netflix subscriber to play them. But you know, it's a capital intensive, you know, business that at a time when who wants to spend more capital? Right now, they're all cutting costs. So gaming's a tough one for me to wrap my head around for studios in that sense. And Apple, of course, already has the arcade offering. So they have that kind of Apple One thing going on a little bit, but they don't talk about it. So
Alex, quick last word.
I think it would have to be done through acquisition rather than organic. Some of these companies have tried it organically, and Netflix is trying it organically right now. I think the jury's very much still out on that. But Activision may come available if the Microsoft deal falls through, and that's certainly in jeopardy. There's several of these other companies that are out there, Epic Games, private company, Riot Games. It is possible, as media thinks about, what do I have to do here? Because I think the industry has to do something that at least this thing is a something that they could at least consider.
Think, I mean, like Comcast, if they jettison NBC, if we just combine all these streaming properties, let the connectivity companies just be connectivity, doesn't that feel like the more natural direction for this to go in?
And I think that will also happen. So it will probably be a dual-pronged approach. I think both can happen.
All right. We'll leave it there. Gentlemen, thanks. Alex Sherman, Sean McNulty.